Hello and welcome to another instalment of the Self-Managed Super Fund Industry Roundtable series. I'm your host, Michael Killicoat from BRR Media, and today we'll be talking about purchasing your business premises within your SMSF. And joining me today are a couple of industry experts, two brand new panellists today. I have Mr. David Cantley, the General Manager, Advisory Services and Distribution from Future Estate. Welcome, David.
Good morning, Michael. Thank you for the invitation.
And also Mr. David Harvie, the Managing Director of Perspective Group. Welcome again, David.
Yep, good to see you, Michael.
So, gentlemen, given using your super balance to benefit the business is against the rules, why would someone purchase their business premises?
Well, I sort of start with why wouldn't they consider it? I think, you know, as we're dealing with clients in the financial planning space, Michael, our clients over the past number of years are conflicted. They're conflicted because, on the one hand, we've just gone through that nasty GFC, which has put strain on cash flows, strain on businesses, but more importantly, I think it's put a little bit of a strain and a dent in the personal confidence of businesses out there and the people that are running them. So that's sort of on one hand. On the other side of the equation, they're looking forward to the next 5 years. We've just had 5 years of tough times, but the next 5 years potentially aren't so bad. And they're also saying to themselves, how is it that I can grow my wealth? How is it that I can still consider borrowing whilst using an asset that's potentially been a little bit lazy in terms of superannuation? So those clients are conflicted and they're looking for a way to, I guess, advance their cause and grow their wealth under some difficult circumstances.
So I guess who would be the key target of people who would buy their premises?
Look, traditionally, Michael, the last number of years it's been professionals. So your lawyers, your doctors, those that are in, they're in rooms or they're in premises and they're subsidising a landlord's, wealth plan. That's what they're really doing. So they're looking at that, they're seeing their outgoings on a monthly basis, but at the same time, they're looking at their super fund statement and seeing that that's not really going anywhere. Mm. So that's sort of the conflict, isn't it, David? Yeah. And at the same time, they may have a residential property portfolio that's been a little bit stagnant, but ironically, at the same time, the commercial property side, David, has been rather robust, I think, and you'd probably agree. So they're seeing that as an advantage and potentially, potentially an opportunity to dip into their superannuation balance, to use it, to make it more efficient, take control over it, and purchase those premises as opposed to paying a landlord. Mm.
So
I suppose it comes down to timing as well. David alluded to the post or prior to GFC. We're talking probably about a commercial asset here. It's probably going to be in excess of $1 million. So when you're looking at self-managed super, potentially you're looking at the balances there as well, but also looking at making sure you've got an effective strategy to start with. So stepping back a step and saying, well, hang on a minute, I'm at this point in my professional career, I've got this sort of cash flow. Is it the right time to purchase the premises, or should I still be renting and looking potentially at the next 3 to 5 years where I could potentially outgrow where I'm currently situated as well? And I think that's an even bigger question, is ensuring you've got the right strategy to start with, because there's no point locking yourself in a particular purchase, especially if it's a commercial asset that's worth more than $2 to $5 million. That's quite a large sum of money for your self-managed super, knowing very well potentially in 3 and 5 years' time you may actually outgrow it and you may actually need to move on to another premises, and you've already locked yourself in within your self-managed super. So it's also a lot harder to offset that asset and sell it on to then move on to a bigger complex as well.
Sure. And what about sort of the size of the property compared with the size of your fund at that time? Does that is that a factor?
Yeah, look, I think it does. And what David's talking about, just taking a step back, the legislation has also opened up this opportunity too, and I don't think that can be overlooked, Michael. There's the external factors. There's the fact that I just mentioned in terms of clients wanting to take control of their future, but the legislation first came into being around about September 2007, then was further ratified in 2009, and more recently there's also been some more clarification around improvements, repairs and upgrades to these properties. So I guess to summarise what the legislation has done is created an opportunity in which a super fund can borrow, The super fund can borrow in very specific circumstances. It's over a single asset, so not over multiple titles, but over a single title, where we're talking about business use. So whether that be commercial premises or residential, where you have a lease arrangement in place, which is a third party, so they're very specific circumstances. The asset itself is the only asset that's used as collateral, and that's important, Michael. So that provides an opportunity for the fund to borrow, but in rather protected circumstances. One thing to watch, however, is to buy that asset with the future in mind, and that's what David's talking about. Once you've bought the asset, it's difficult, in fact it's prohibited, to borrow again to upgrade that asset. You can certainly repair it, you can certainly maintain it so that you're, I guess, not requiring to repair things in the future, but one can't borrow to upgrade that asset, and that's an important distinction. So this is a transaction that shouldn't be entered into lightly. I'd certainly advise getting advice, appropriate advice, and having the structure set up correctly from the outset.
And I guess once you've actually gone ahead and bought the property, how does the rental arrangement work?
Well, that's the really, that's sort of the enticing part is, as I said before, rather than the rent check every month going off to an external party or lining the landlord's pocket, you're actually renting to yourself or leasing the property to oneself. So as the trustee of the super fund, and we have a number of examples of this where we've had clients who are saying to us, well, hang on, we're trustees of a fund, or we want to be trustees of our fund. We have this external third party that we're leasing to. Let's lease it to the fund. Well, let's pop it in the fund and lease it to ourselves. Now, that provides a double-sided transaction. On the one hand, your business that's leasing the property receives a deduction, of course, receives a tax deduction, and that could be deductible at the rate of 30 or even 46.5% in that sort of bandwidth. On the other hand, the super fund is receiving the rent proceeds at market rent. So we're not discounting in this example, but at market rent, and that rent is assessable at an income tax rate for the fund of a maximum of 15%. So it's very enticing to be leasing to oneself in that circumstance.
And it's also important that you're also the property manager, because that's an additional expense. So if you were actually not the landlord, you were paying rent still, you'd have a property manager which should also, under the landlord circumstances, you'd be paying the property manager as well. But in this case, you're the landlord, you're the property manager, you're also the tenant. You know, you've got all three in one basket, which is very, appetising as well, especially if you've got good cash flow coming through and you're planning to grow in the future as well.
It's about control, isn't it, David? And it's about
control and stability.
Control and stability.
Sure. So with the having to pay rent at the market price, what about the other issues of a rise or even a fall in the property values? Are any issues there?
In terms of capital gains issues or
Yes.
anything like that? For our funds, obviously, every fund needs to complete a tax return every year, and when it does that tax return as a tax-paying entity as such, there'll be valuations that are done, and one of those valuations, if there's liquid assets such as cash or shares, that's very easy. It's the valuation as at a particular point in time. For the super fund, valuations are done for the property as well. But if there's a rise and fall, Michael, there's no need to account for capital gains within those years. A couple of things to consider though, and in some of the clients we've worked with, they're again buying with the end in mind. So, for example, with a pre-retiree. So a couple of clients we're working with at the moment, husband is 58, wife is 55, their combined super balance is around about $500,000. Very successful plumbing business, they've been there for 15 years. They're looking ahead to the next 5 and 10 years and probably will retire in about that time frame. So how is it that they can acquire the asset today that they're leasing from, pop the premises that they're using for the plumbing business into the super fund? Well, they can borrow to do so. And then looking forward, when they do realise that asset and sell it, potentially they would have retired or at least been in pension phase. Well, the important thing to note is if that asset is sold when one is retired or in pension phase, there's zero capital gains. It's a very enticing transaction. So not only is the tax benefits along the way quite enticing or appetising, but zero capital gains on retirement is quite the enticement for them in terms of that transaction.
And if it is the largest asset within the self-managed super fund as well, and the value drops, then that's obviously going to have a major impact on your retirement savings as well, because we are potentially talking about a commercial asset here, multiple millions as well. So that's obviously needs to be taken into consideration as well, because the last thing you want to be doing is putting your savings off for a further 10 years as well, if it is that largest asset within the self-managed super fund.
Yeah. Are there any other disadvantages that people should keep in mind?
Look, I think really just the value is probably the biggest disadvantage. Obviously, if it is the largest asset, you just need to be careful. That's obviously having a diversification strategy is very advantageous, and that's where David's expertise come into it, because a financial planner will ensure you have a diversified strategy. You won't just have a pool of assets within one asset class. You'll make sure it's maintained a diversified spread. So that's probably one of the only key disadvantage is the value, just ensuring that you're buying at the right time, you've got good cash flow, you're not also predicting in 5 years' time you're going to outgrow that premises as well, because as David said, it's very hard to offload that asset and then acquire another one based on those circumstances in potentially 5 years' time when you've outgrown it.
I think there's another angle to that as well, David, and I think there's the ability to buy the property outright. So that negates some of these problems. If the super fund is large enough to acquire the asset without any borrowing, that's obviously a lot easier. If there is borrowing involved under these circumstances, personally one can lend to the fund, so the trustee can actually lend to the fund, but more often than not our clients are using bank facilities to do that. And that's a tricky area. Number one, not all banks understand the legislation, ironically, even some of the top four. So again, pertinent advice from your accountant and planner around this is very, very important to ensure that you're setting the loan up correctly in line with the legislation. The second thing to watch are the gearing ratios. When one's borrowing in one's own name, even for a commercial property or for a residential property, generally you can gear at 70, 80 and sometimes even 90%. If you're borrowing with a super fund, the maximum most banks will go to is a 60% gearing ratio. So that means you need at least a 40% deposit for the transaction. You'll need another 10 to 15% for incidentals, legals and so on. Banks also like to see another pot of money or another amount that's set aside just in case something goes wrong. So the general rule of thumb we use with our clients is around about a 50% minimum deposit for that particular transaction. So when you're looking at the size of your superannuation balance and then you're looking at the size of the potential transaction, those gearing ratios need to be taken into account.
And a lot of this came into, I suppose, impact post-GFC, didn't it, where lending criteria tightened significantly, because I think the LVRs were actually a lot lower than that prior to the GFC, and I think the GFC has brought around this change in criteria from a bank lending perspective as well, which has made it even harder. As David said, 50% LVR that's half the value of the asset that you're looking to purchase.
So I've covered a lot of information so far, but is just a case study you might have for us just to truly explain how it would work?
Yeah, probably talk about Dr. Samantha. So Dr. Samantha's been with us for many years, and initially we started, I often think of super funds as stages in life. So Dr. Samantha came to us with an industry super fund. Not that there's anything wrong with that, it was doing the job for her. She'd taken that from various postings over her time. In fact, started with that fund at the start of her career. It was nice, it was easy, it was doing the job. Around about 6 years ago, we started as her qualifications moved up, and she moved from a specialist through to a gynaecologist through to an obstetrician. Obviously, those earnings started to ramp up significantly, and as we were working with Dr. Samantha, and those earnings were ratcheting up, so were her contributions to super. And that's the thing to watch as well. Just on a side note, is it's tougher to get money into super. So being mindful, and it's another topic for another time, the contribution strategies, but being mindful of taking the opportunity to make the most of those contribution strategies is important. So we've done that for the past 4 or 5 years with Dr. Samantha, and we moved it from the industry fund to a wholesale fund, which is a step before the self-managed super fund. That's an important step. Oftentimes, clients are stuck in the industry fund or stuck in the retail fund. They're not really growing their super, they're not taking control of it. So, there's a step before self-managed super, which is the wholesale environment that clients may want to consider.
Sure.
We commenced the self-managed super fund around about 18 months ago. She had a balance of close to 440,000 through the last 6 or 7 years of concerted contributions and trying to grow those monies. And in the last 6 months has recently purchased her rooms. She purchased rooms that are probably a little bit bigger than what she needs at the moment, about 20% bigger than what she needs at the moment, but that's with the growth strategy in mind. Purchased rooms that really don't need too much upkeep, don't need too much maintenance, so again, not having to tip any more money into that particular transaction.
Sure.
We went in with a relatively conservative gearing ratio, so of the 440 that she had, we earmarked 300 for this transaction. 300 in borrowing, so around about 610 in terms of the purchase price, which means that Dr. Samantha has a nice balance outside of this particular transaction that we're offsetting some of those risks that David was talking about before. So we've purchased or invested in a range of assets that are completely unrelated to commercial property. They're direct Australian shares, some fixed interests, some cash, term deposits, etc., even some international managed funds, not related to the commercial property market at all. And the last time we met with Dr. Samantha was about a month ago, and her first, apart from all the numbers now making sense, apart from her being in a very tax-efficient environment, the first thing that she said to us is, I feel great because now I've got control. She knows what the future holds. At 48, she knows that in 10 to 12 years' time, when she's considering pension phase or retirement, she's working towards that with this particular asset.
Okay.
And it wasn't a purchase straight away, was it? Obviously, she had really good cash flow, understood the premises, understood her strategy moving forward. As you said, the 20% growth as well. I think that's actually really, really important as well, is don't rush into the decision and understand your cash flow situation. Obviously transitioning from a non-ownership super fund strategy to a self-managed super fund strategy as well, giving you that flexibility and control of the assets within that structure.
Okay, sounds like a good example for people out there to listen to. I'm afraid we're out of time today, but David Cantley and David Harvie, thanks for joining us today.
Thanks, Michael.
Thanks, Michael. Pleasure.
That's been another instalment of the Self-Managed Super Fund Industry Roundtable series. If you have any questions, email brr@brrmedia.com. I'm your host, Michael Killicoat. Thanks for watching.